So you got to trade market conditions, right? And with the markets going up over the last couple of months, covered calls have been really, really tough to sell. You sell a covered call, shoots above the strike, you have to keep on rolling and rolling. But when the markets are like this, LEAPS, they work awesome. So I've switched over to buying options. So I'm going to tell you about the new LEAPS that I just purchased, really what that means and why I prefer that over just buying shares, as well as how I'm going to sell calls against that LEAPS to make extra money in premium. Now, if you've never bought options or dealt with options before, this may seem foreign, the things I'm going to say, and really, really confusing, but trust me, it's not once you learn it. I've made tons and tons of videos about options. I'll link some at the end of this video, also some important ones down in the description below, how to close an option, what the Greeks actually mean, things that might confuse you in this video. I'll make sure I cover those bases as well. So here is the Robinhood portfolio, July 11th, 10:39 in the morning. And you can see most of these are calls. Call, 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 and put. Now, what we will notice, like I just said about the covered call, is that a lot of these started as weeklies, and then the prices just continued to skyrocket, and I needed to roll them out in expiration, which isn't really a big deal for me. I never want to go to expiration. And with that, all of my capital gains on the 100 shares that I own, you can see I pretty much just trade the top S&P 500 stocks, 100 shares, Microsoft, Apple, Amazon, Google, Starbucks was a put that got assigned, and Nvidia. And some of those calls have been rolled out as far as June of next year. My Apple call, 6/20/2025, as well as Google is out there. So like I said, really, really hard. But right now, as things continue to go up, I like to look at LEAPS for good quality companies. Now, it's really, really hard to do that as well when we're at all-time highs. It's hard to buy at all-time highs, and it's especially hard to buy right now going into earnings. But I think if you do a little bit of research and you understand what's going on, you can pick the right stock. And I will explain to you why I chose American Express as my next LEAPS and poor man's covered call. Now, I like to look at things from a technical analysis as well as looking at the fair market value of a stock, which for most stocks right now is very, very high. So I'm using my knowledge of technical analysis to really make this trade. We can see this is the daily chart. So every single candle is 1 day of action. From all the way back to January 2024, like most of the market, it's been on a continuous uptrend. Now, when things get interesting is right here through May and June after last earnings. After last earnings, we had a nice pump, and then it kind of consolidated around, but it came back down and it tested that earnings right before that pump, right in this zone here. And what it did, it came back and tested it right around June 13th. And since then, it has made higher highs and higher lows, higher high, higher lows. And right here is where I said to myself, okay, this could be a good position going into another earnings that we might see another pump, since it retested not only this level here, but we also had a test here, which was very similar here. And we shot through that nice and strong. We had another pullback into this zone right here, pullback nice. So now we have ourselves a nice quadruple top on the daily chart. So what I'm hoping for when I bought right down here around 236 as it started to pump out, I'm hoping we break through that quadruple top. We come up and we test highs again at about 244, and then we continue upwards over the next year. That's my analysis for making that trade. And although I hate trading right around earnings because of Ivy Crush, I feel that we're still far enough away from earnings, looking at the implied volatility, that we're good to go right now. And if anything, the implied volatility may raise, increasing the price of my LEAPS, and I might get to a profit target that I want in the next couple weeks and maybe don't even have to hold it for the next year. But that's pretty doubtful because my break even on this trade is all the way up around 255. So it's also worth noting, guys, what am I using for LEAPS? They has to be a good quality stock. If you're going to do this with penny stocks or shit stocks, guys, you're going to get wrecked. And there's a good chance that you might even get wrecked with good quality companies, depending on when you choose expiration and how it works out. But you are just raising your risk exponentially when you trade this with crappy stocks. If you can't afford a LEAPS option with a good quality stock, invest like a normal person. Like, you don't need to rush into this. Save up some money, invest, and then make your LEAPS later down the line. I pretty much will not go above 10% of my total portfolio, and you will see the cost as compared to my portfolio value. I just won't do it. I'm old, call me a boomer. My risk is really, really low. That's just the way I like it. if you are going to over leverage yourself, there's a pretty good chance eventually you're going to get smoked. Now, there are assets on the S&P 500 that I would take, but like I said, I already own 100 shares of Microsoft, Apple, Amazon, Google, Nvidia. So when I'm looking down the line at the S&P 500 stocks that I really, really like, a couple of them are, I either own them or they are really, really overvalued for my opinion. Now, like I said, American Express still a little overvalued, but looking at the technicals, that was a good spot and it's been on my watch list for a pretty long time. So besides a good quality stock, the next thing that I'm going to look at is the delta value. And like I said, if you don't understand the Greeks, I will leave a video at the end down in the comments section. Please check out the Greeks because it is very important. Unlike the covered call where you can use delta as kind of like an indicator, I think it's even more crucial when you're looking at LEAPS. You're going to be looking at delta and definitely implied volatility. So I'm looking for a delta between 0.75 and 0.85. And I made this trade at 0.78 delta. Let's look and see what it is today because it does change daily. Currently right now, the delta has increased to 0.80. So that's actually a good thing for me. And why this is a good thing and why LEAPS are such a great opportunity to take a little bit more risk to get a little bit more money. Delta is defined by how much the premium of this option is going to increase for a $1 increase in the share price or a $1 decrease in the share price. So essentially, right now, this is like me owning 80 shares, right? Because if American Express goes up $1, I make $80. Where if I owned 100 shares, it would go up $1 and I would make $100. So I hope that makes sense on how I'm using delta to really show the leverage that this asset and this option is going to have. So I paid $4,500 for this option. And once again, going back to my portfolio, that is less than 10% of my total portfolio. So this is going to be the LEAPS that I'm going to play from now on. All right. And what I paid for this was $4,500. If I was to purchase 78 shares, which was the delta when I opened this option, I would have paid for 78 shares at a share price of $236.41. That's what it was when I purchased this option. That's $18,439.98. So I got the leverage of $18,000 and change for only $4,500. That is one of the major benefits of the LEAPS. It's also great because what is my max loss for this option? Well, the max loss for this option is the premium that I paid, $4,500. Where if I had bought 78 shares for that $18,000, what is my max loss there? $18,000. So I know people say, like, what happens when the share price goes down? Guys, sometimes the LEAPS is going... Gotta fly. Sometimes the LEAPS is just going to die. Like that happens. Sometimes you lose in trades. But there are going to be ways to mitigate that risk as time goes on and as we approach expiration. I'll get to that in 1 second. So now I've got a good stock that I really, really like. It's less than 10% of my portfolio to buy the option. I got myself a delta that is between 0.75 and 0.85. The next thing that I'm going to be looking for is expiration. And I want this expiration to be pretty much a year out. Ideally, I would say like 13 to 14 months is when I really, really want to purchase this option. One, to give myself some time for the option to do what I need to do. But also as well with options, we know that theta is the cost, the pay to play essentially, and that is going to eat away the option. And we can see right now when I am a year out, I have a theta of 0.04. So this is losing $4 in premium every single day. And this is going to steadily increase as we approach expiration. That's why I said 13 to 14 months, because at 30 to 45 days, that's when we really see theta start to really eat away at this option. So by going far out in expiration, we allow ourselves to not have theta affect the premium as much as it would if we were close to expiration. And the last awesome thing that I can do with this options contract can be used as collateral to write calls against it if the strike price is above the break-even price of this LEAPS option. Now, this can be risky, and to do so, I write only very, very small deltas like 0.1 to 0.2 when I am doing this with the LEAPS, because we are going to make more money on the LEAPS options profit than any premium we could collect, but it is still nice. So essentially, if I have a break-even listed here at 255, I can go to view all options and I can sell a call against this as long as it is above 255. So if I want to go here, I can make $38 on a covered call using the LEAPS option as the collateral, like owning 100 shares. This is called the poor man's covered call, or more technically, a calendar spread. But I'll probably wait on writing calls a couple weeks. I like to see what the option is going to do. I'll probably wait till after earnings, to be honest. But how am I going to mitigate this trade? First, just like any trade, I like to have a stop loss, and I also like to have a profit target. Doesn't matter whether you're day trading or swing trading, guys, you should have these in mind before you buy those options. If we go back to the technicals, guys, if it breaks below 233 and we start to see it move downwards, I am probably going to exit this trade, or if I feel that it is going to bounce off of that again, I might buy another one. I tend to hate buying losing trades. I would rather sell it off at a loss and maybe enter a new LEAPS if that's possibly what I want to do. But it depends on where on the timeline that happens. So that's one of the first options. Buy in to lower my average cost. Just close it at a loss and open a new one. So when it recuperates, I can do that. That's usually going to happen if we're a little bit farther along in expiration. So that's kind of where my stops are. My take profits are probably going to be in the neighborhood of 75%. If it gets to 75%, I'm going to take the win on that, even if it happens in a week. Like I said, I have the long expiration really just to help me with theta. But if things go right, I will probably close at 75%. If it blasts through 75%, I might see what happens and then use 75% as my new stop loss. We'll see, and we'll mitigate the trade as it goes on. I will definitely update you on things that I do with this trade. If you have any questions about LEAPS options, just leave them down in the description. And if you're here a couple of months from now and this is getting cooked, feel free to tell me what an idiot I am in the comment section down below as well. I always appreciate when people like to remind me of what an idiot I am. But over here, I'll leave that Greeks video as well as closing options video so you can check those out. I hope you guys like this video. If you do, please consider subscribing, give the video a thumbs up, and I'll catch you on the next video.